Hello there. Well, Rachel Reeves' next budget is not till the 26th of November, but if you were to read the newspapers at the moment, you would probably think it was next week, because there's been so much speculation, in particular about what tax increases she might want to do. Now, I think it's really important to point out that this is purely speculation at the moment. We can't know at the moment, and nobody knows what she's going to do, whether she's going to have to increase taxes and whether she's going to have to cut spending, or perhaps neither of the above. So I think it's very important that nobody does anything right now. Once we know what's going to happen, of course, if it affects any of our clients, then our financial planners will be in touch. But from an investment point of view, I think it's quite interesting to look at the reasons why there is so much of this speculation and to see if there's any implications for the UK economy and for UK investors. Now, I think the reason why there is so much speculation is really due to a few things. Partly it's due to the way that we sort of set budgets in this country and the budget process around it. There's a little bit to do with markets, but mainly it's all to do with the kind of constraints that the Labour government have set themselves. And those constraints come in kind of two forms, if you like. There's the manifesto promises. They promise that they won't put up income tax, personal, if you like, national insurance, corporation tax, or VAT. And if you add all those together, then that comes to about sort of 2/3 of the government's revenue. So they're not going to touch those, then any taxes they do have to increase have got to come from somewhere else. And then the second point is their so-called fiscal rules. And this is something that governments tend to sort of set themselves, rules that they will abide by with their finances. So there's two main parts of the government's fiscal rules that I think are quite interesting and important at the moment. One is that the government spending has got to be funded by revenue day to day rather than by borrowing. And then the second one is that the government debt as a percentage of its GDP, or as compared to the size of our economy, for example, has got to be falling essentially by the end of this Parliament. And it's that last bit that could really make Rachel Reeves do something perhaps she doesn't want to do. Because if the Office of Budgetary Responsibility, the OBR, comes out with a forecast at the next budget and says that actually that target isn't going to be met, and that the government debt is not going to be falling relative to the size of our economy, then Rachel Reeves has got to do something. Or she's going to have to break manifesto promises or the fiscal rules. They've got to have to raise taxes or cut spending. So that's the sort of source of the kind of speculation, if you like. Now, this chart from the OBR from March this year shows that kind of the problem that we have, but it also hints a little bit at the solution. So the solid green line looks at our debt, the government debt, as compared to the size of the economy, and how it's projected to grow over the long term. And you can see from that solid green line that essentially it looks likely it's going to fall by the end of the Parliament, which is obviously what Rachel Reeves has set herself as a target. But then the debt starts to grow again. And by the 2050s, it gets to 150% of our GDP. By the 2070s, it gets to over 200%. And of course, that's a very long term. We like to be long-term investors, but that's still a very long time away. But the core reason why that debt is expected to grow over the long term is basically down to demographics. Our population is getting older, therefore over time there will be fewer people working relative to the size of the number of people who are not working. An older population would tend to mean more spending on healthcare, more spending on pensions, but we'd be getting less revenue in because of the fewer number of workers. So that's why that debt to GDP looks like it might increase. There is a hint on here though of the potential solution. If you look at the solid yellow line, this is what would happen to our debt were we to be able to increase our productivity. If we were to increase our productivity not by the 1.5% per annum that the OBR currently thinks we're going to do, but if they did it by 2.5%, you can see actually over time our debt would start shrinking compared to the size of our economy. That's because if we can be more productive, we can grow the economy more quickly. So even if the debt grows, the economy grows more quickly, therefore the ratio between the two falls. So how do we increase productivity. Well, the government has tried lots of different initiatives for doing that. But essentially, some of the ways we might be able to do that, well, AI might help, but that's very uncertain. But one of the things we could do is try and spend more on things like infrastructure, things like green energy and all those sorts of things that are supposed to make us more efficient. Because actually, there's loads of evidence out there that shows that generally you get back much more than you put in if you invest in those sorts of things. So that's one way we could make things more productive and help that long-term picture. There are other things we can do. What we would urge the government not to do is to go out and cut spending now to kind of meet their short-term fiscal rules, which then might damage the long-term picture. I don't think that's a sensible thing to do. So it is a very interesting time at the moment. It will be interesting to see what they have to do. And this situation is exacerbated a little bit by what's happening in the government bond market. You may have seen headlines in the papers recently about the yield on the government gilt 30-year bond hitting at the highest level that we've seen since the late 90s. And there's even been some speculation that means that the UK might need an IMF bailout at some point. Well, that frankly is nonsense. But the increase in borrowing costs could exacerbate that problem over time, because obviously if we have to spend more on interest on the borrowing, then that impacts on the amount that the government can spend elsewhere. And it's important to point out this is an international problem. Lots of countries have got the same demographic issues that we do, and essentially what that means is that over time you expect there to be a greater supply of government bonds. In other words, we're going to have to borrow more, and at the same time we might see less demand from people like pension funds. At the moment in the UK, lots of final salary pensions funds have got great demand for those gilts, those long-term bonds. So if there's a reduction in demand and an increase in supply, then of course that means that it impacts the price. Basically the price goes down, the yield goes up, and that means the government will have to borrow at a higher interest rate. But that's something that other governments are already having to deal with as well. So we've seen at the same time as the yield on UK bonds has gone up, the yield on German and Japanese and US bonds has also gone up too. So it doesn't mean we need an IMF bailout. In fact, the last gilt auction was actually 10 times oversubscribed. So more than 10 times the amount of bonds that were being sold off by the government, there was demand more than 10 times that amount. So that's not a problem, but it is a long-term issue that those borrowing costs will increase. From an investment perspective, that means that actually we'd rather not hold those long-term government bonds. We much prefer holding shorter dated bonds, and at the moment we generally hold more corporate bonds than government bonds. So we'd rather lend more money to companies than government because we get paid a bit of a higher yield and it doesn't have some of those concerns. But if the UK could perhaps ensure that we don't cut spending on some of those things like infrastructure, some of the other projects that hopefully might make us more efficient, actually that means that there could be opportunities for UK investors as well. So we've got to be careful about getting this balancing act right. Don't go and increase taxes too much or cut spending too much just because of short-term finances. We do think the long term is more important, and if we can get that right, then actually the UK economy can improve, and that can be a positive for investors as well. So I hope you found that useful. We'll see you again next time. Thanks.